Good morning, everybody. Welcome to our October edition of our Inner Circle workshop. As you'll probably notice, we have a special face here today. So Brad is currently getting I believe it's a crown replaced. So some really fun dental work that sounds like it was somewhat of an emergency.
Yeah.
So he's having a lot of fun. So keep him in your thoughts. So I'm missing my Starsky to my Hutch to Scott. I don't know, one of those two. But Scott stepping in, our very own Scott Airy stepping in today to play that role. And today we're going to be talking about long-term care. So it looks like we have some people filing in. If you could, as usual, just drop something in the chat box, let us know that you can hear us okay. That would be fantastic. So just say hi or hello or something so we can see and make sure that you can hear us. And I'm going to jump into some announcements before we do that. So our subject today is long-term care. And it looks like Mary and Scott, so sounds good. Good morning. Hi from St. Louis. Good morning, everybody. All right, so I believe Missouri is featured in one of our questions today. So that's exciting. All right, awesome. They're filing in. Thank you, guys. All right, so subject of long-term care. To some that might sound, it may sound exciting. To others, it may not sound very exciting at all. But personally, I had a blast like digging into the research. This is one of my favorite things is to take a subject, kind of take a really wide lens view at it and just dig into some different ideas. So before we get to that, just a couple announcements. For those of you that have joined us in the past, you'll know we're going to pull up our website and go through some of the upcoming events we have coming. For those of you who are just joining us for the first time, thank you for being here. Hello, and we appreciate you joining us. This is our website. For those of you that have been around for a while, for the longest time, Brad has been working on this book and he would not talk about it. And so I would constantly be nudging him to share his book and how it's going. And once it was done, now it's everywhere. So I see people and they say, yes, I know there's a book. I see it. I've been reminded several times. But when you come to our website, that's the first thing that's going to pop up. Spending money and having fun. Brad's book that has launched. Go check it out. There's a link on here where you can go straight to Amazon. And it would be awesome if you could actually leave a review as well. He's done a better job of asking for that, but I like to be a proxy and ask him so he doesn't have to seem selfish.
And share it with some people you know. I mean, it's a great read. It's quick. It's got a lot of really good, useful information. Those of you on the line today that kind of know our process and how we look at things, it really, I think, just dives deeply into all of those concepts. And for those of you that are kind of new to Fiat or haven't, taken the opportunity to sit down with us and talk about those things, it'll give you a little perspective on how we look at things. So I thought it was fantastic, and Brad did a great job. I mean, we literally can't get him to stop talking about it. So
it backfired. All right, guys, just a couple things, a quick tour of our website. So upcoming events, we have our event today. This is something we like to steer you to. So Inner Circle workshops, we have one more for the remainder of the year. It's coming up in November. We typically will take December off until we hit that new year. So as of right now, that's financially preparing for the new year is our topic. That's going to be just strategies and tactics to feel like you have some closure on the current year and look ahead at the next year. One of my favorite times of the year is I love the planning and kind of the fresh start. So you'll also see on here some of our other education sources. So we just had a blog post that we just posted yesterday. So you can go here to read our blog and how to financially prepare for the holidays. So that's the most recent. Our podcast, if you've not checked out our podcast, jump in here. So, and if you have, we'd appreciate you if you leave a review for that again, just so we become more and more relevant, something we really enjoy doing and diving into some different topics. So on that note, stay tuned because long-term care that we're covering today, that is going to be a topic coming up soon on our podcast as well. We also have our current clients. We'd like to remind our current clients that if you have not booked your year-end visit to do so, and you've probably heard, hello, Brad. The
You're on mute, Brad.
you've probably heard he must be done with his appointment.
Probably still hopped up on the gas, it looks like.
You've probably heard from us already, but you will hear from us. Just a reminder to schedule your year-end visit if you have something that you'd like to talk through. We typically like to get those through in November to feel prepared for that next year. And as always, you will see the schedule a visit block where you can go find which advisor you want to schedule with. All right, anything else? Oh, one more thing. So social media follower, each month we choose a social media follower from one of our different channels and they will win a $20 Amazon gift card. Our winner this month is Brad Blackett. So congratulations, Brad. Stay tuned. Jen will connect with you to arrange that gift card. All right, so we are going to jump into our quiz for today. And Scott, anything else to add?
Well, I don't know. Do you want to? I always come prepared with a joke.
All right.
Those of
let's
you
hear it.
that have witnessed me here, we're big fans of dad jokes around the office.
That we
and
are,
so
yes.
I think I have a doozy for you guys
A
here
doozy,
today.
a doozy. Under
Since
promise,
we-
over deliver.
Since we're on the topic of long-term care, I tried to keep everything in that vein. So, Matt, what do you call a nursing home with a buffet?
I don't know, Scott.
Golden Corral. In fact, the one near my house has one of the lights off on the sign and it says Olden Corral.
Oh
I
my
always
gosh.
find that pretty funny. So there's my dad joke for
Thank
the
you.
day.
That was
Enjoy.
that was fantastic.
You're
I
welcome.
love it.
You're welcome.
All right, everybody, if you have not joined us before and this is your first time, how we usually structure these inner circle workshops a majority of the time when we are hosting is we have what we call a fun and friendly quiz. So we call this fun and friendly. We do get a little bit competitive because I like to see who's winning between us and our guests, but it's all in good fun. So we don't expect you to know the answers. The reason we do this is for educational purposes. So we actually want you to get a lot of these wrong. And if you do, that means that we're doing our job and we're teaching you something new. Okay. So I'm going to go ahead and launch the poll. We're going to give you a few minutes to get through that fun and friendly quiz. We're going to come back in a few minutes. We're going to go through all these questions together, and that's going to be our education piece as we go through each of those questions. I would love to share music with you, but we've had some copywriting issues, so we're going to have to keep it silent today. And I'll go ahead and launch this. And have fun, everyone. All right, guys, we have about 70% of the people have votes in. I'm going to give it about 30 more seconds and we'll wrap it up. All right, everybody. Thanks for going through that. Looks like we have a majority of the votes in, so we're going to start going through each of these questions. So I'm going to go ahead and share the results. This is my favorite part. So we get to see if we are able to stump you or not. And all right, I'm going to start with question number 1. What percentage of adults in the United States with a postgraduate degree live within an hour's drive of extended family? So first question, the first option was 33.6%. 24% of you chose that. 42%, 24% chose that. 63%. We had 7% of you that chose that. That's a lot of percentages, sorry. And then 20.4%, the majority of people selected that. 45%. All right. So you may wonder how this has anything to do with long-term care and the topic we're covering today. As I dug into this research, I had this conversation with Scott, and Brad and I had this conversation about how fascinating the topic of long-term care insurance is in general. So if you look at our culture in the United States versus other cultures, you'll see a lot more extended families living together. So we started the conversation thinking that pattern seems to be changing within the United States. So before I dug into this, I actually thought that the number would be much smaller. So the correct answer is 42%. So 42% of adults in the US with a postgraduate degree live within an hour's drive of extended family. With the interstate system and airline travel and higher education becoming more of a trend, I had assumed that it would be much lower. So I actually, before digging into the research, probably would have guessed 20.4%. But the correct answer is 42%. So 42%. And just a couple other, all this data comes from the Pew Research Center. This is all as of 2022. So if we look at kind of the different levels of education, so 42% of adults with a postgraduate degree live within an hour's drive of extended family. 48% with a bachelor's degree, so just one step lower, live within an hour. 56% of those with some college experience. So you see this pattern coming down and down and down. And finally, 63% of adults with a high school diploma or less live within an hour's drive of extended family. So linking this all together, thinking about the interstate system, higher education, the tendency for people to live further away seems to coincide with there being more of a need for long-term care. So if I am a couple who's in my late 80s and my adult children are not living in the same state as me or close to me, there's a higher likelihood I'm probably going to be thinking about how to plan for my care, as opposed to thinking my kids are going to be part of that. So I thought it was a fascinating thing to dig into, and again, I thought that number would be quite a bit lower. What I do find interesting is that the trend towards more and more people that are going on to receive higher education, as we can probably all guess, has continued to increase over time. So just another quick stat that I think is interesting. So in 2020, about 37.9% of the US population 25 and above had graduated from college or another higher education institution, compared to the year 1960, when only 7.7% of the US population to graduate from college. So we do see this trend that is a long time period. But again, just drawing that trend towards people starting to live further apart. So, but for those of you keeping score, I did stump you. So one score is 1-0
for us. You can. I thought that was a very interesting perspective. Probably a lot of you are thinking the same thing, like, why is this the first question on the poll, and how does this have anything to do with our topic today? But I think it correlates very well with what has been going on in, call it the long-term care industry, right? As populations get older, there's obviously more of a need for care, and a lot of the conversations that need to be had in today's world is, how is that care going to be provided? What are the options? What does it look like? What are the different types of care? And so that led me to a pretty obvious question in my mind of, like, what is long-term care, right? If kids are moving further away from their families or moving closer, like, either way, we still have to provide some sort of care. But what we have to understand is there's some different levels involved in all of this. And so I threw out some examples in the question here of what could be an example of a long-term care scenario. And the first question was, Pam needs to help her husband in and out of bed. 17% of you said that is a form of long-term care. My watch is talking to me. Don is visited by a physical therapist twice a week. 10% of you mentioned that is a form of long-term care. Joe, who is dropped off every morning at a community center and picked up in the afternoon. Sounds a lot like daycare to me. 14% of you thought that was an example. The last one, none of these. You must be admitted to a nursing home and receive formal care from a licensed professional for it to be considered long-term care. 2-0 fiat. All right. The only answer in this question that is incorrect is D, which 59% of you answered yes.
To be fair, that's kind of a trick question.
It is,
I'm not sure,
but I thought it was more of a
all.
layup because the odds are in your favor, right? 3-1 to get that one right if you were purely guessing. So long-term care, as we define it, it really exists on a continuum or a spectrum of needs. And it starts very simply with this idea that, like, if you can't perform certain activities or you need help in your day-to-day, that is actually a definition of long-term care. And as we dive deeper into this topic, there are ways to, like, provide services and help. Like, Pam doesn't need to help her husband in and out of bed every day if the need arises. There's a level of care where somebody could come in and help with that sort of thing. Okay. All the way on the other side of the spectrum, we have options where, I mean, it's pretty straightforward. Like, somebody's in a position where they can't do anything. Their cognitive abilities have completely gone away. They're unable to really take care of themselves, and they might be so ill or in such a dire scenario where they need 24-hour care around the clock. Very big spectrum when we think about what falls into that. But just think about the idea that anytime we need help in this area, it is technically considered some sort of form of long-term care. But it starts to get pretty sticky as far as the rules and the regulations, and these definitions play a pretty major role in how we can cover some of these costs and what the different programs available to us and the options available to us to fund these types of care. It's very important we understand what is covered, what's not, what these definitions are. This has changed, I would say, pretty recently, right? I mean, a couple decades ago, when we get back, or more than that, actually, back into the early 80s. Prior to that, there was really two options. Your family took care of you in more of an informal setting, okay? Or you needed to go to the hospital or a nursing home, so to speak, to receive care. And that's where, you know, the conversations I've had with my clients and different people over the years is most people are under the impression that long-term care is nursing home care. And I think that our answer today is pretty evident. It's not the case. And a lot of the programs established today, a lot of the different insurances that exist out there provide benefits across this spectrum. And I'm going to dive into some more of these scenarios. But yeah, it really wasn't until the 1980s where, I mean, your generation, your parents' generation, the baby boomers, I mean, everything we're dealing with in our world has really come from, you know, post-World War II needs. population was expanding, costs were expanding, all of that has really created this different continuum or this different spectrum. And I think it's funny that as Matt dives into this idea that as we get more educated, right, kids grow up, get degrees, we've become smarter. So we understand that there's a different level of need. And I think that provides us a lot of opportunity to really plan around this area of our lives, knowing that there's many different stages. So just important to understand what you have available to you. Is it family? Is it informal care? And are you prepared should you need to go into something as extreme as full 24-hour care around the clock? But yeah, at the end of the day, there's the qualitative and the quantitative aspects to this conversation that need to be considered. So pretty interesting conversation when you look at it from the two different spectrums or sides of the coin.
I think that that all brings up a really good point, in that majority of the time, it seems, personally anyway, a lot of us have our own personal experience where we dealt with parents or someone we know that has gone through this process of requiring long-term care. This isn't talking about the insurance or any ways to pay for that at this point, just requiring some sort of long-term care. If I'm sitting in my shoes and I'm going through my own planning, as humans, we tend to think in extremes, I believe. We go to one extreme to the other. So I think in my mind, long-term care for me immediately is assisted living or a nursing home. So I think that brings up a really good point, in that it's really going to cover a huge wide spectrum of many things.
Absolutely.
Which just means the likelihood of there being some sort of need is just that much higher. So good point. We did have a Q&A come up. So someone pointed out, just want to let you know that number 2 is correct for most long-term care insurance, but mine pays 75% of home care. So really, really good points. The one thing, as I just mentioned, what we're talking about right now is just the care itself. So we're not getting into the insurance quite yet. So as we get into that, there's so many different bells and whistles and options that come there. So thanks for bringing that point up.
Yeah, and again, it comes down to the definition of the type of care. And again, the continuum or the levels of care kind of start with what we would call custodial care. Like somebody comes to your home, okay, or you've done something to your home to upgrade it to provide the resource and the benefit that you need. Like it could be as simple as, like, it's kind of funny. In college, I had one of those chairs, motorized chairs that went up the stairs. Very fun to have in college, but obviously the previous owner needed that to move up and down their household. But then the next level is more of what we'd call intermediate care, where something like a specialized, or call it an educated, licensed professional is coming to you, right? A physical therapist drops by to provide some sort of speech therapy to help with your form of long-term care needs. And then obviously the next level is that full-on medical need, where it's overseen by physicians, it's prescribed by doctors, you're in a facility. Like there's a continuum. So many different insurances, many different types of programs out there, and we're going to dive into those things as we go. But very good point. Very good point.
Excellent. Let's move on to question number 3. So Fiat 2, you guys 0. Sorry. Said
remind you.
Number 3, where is the most expensive state for long-term care costs? 17% of you selected Alaska, 45% of you selected California, 14% selected Connecticut, and 24% selected Florida. The correct answer is actually Connecticut. So California, I likely would have guessed that as well if I hadn't dug into the research in a lot of detail, but just a couple of numbers for you. So this gets a bit tricky because, as you can imagine, compiling this data every year, they usually look at it state by state, but I do have some kind of city by city or region by region comparisons as well. So the most expensive market for long-term care is the Bridgeport, Stamford, Norwalk area of Connecticut. The average cost of a room in a nursing home there has reached $159,359 for just 1 year. So Alaska actually came second, and Anchorage, Alaska was $156,950. I do want to share an interesting tool with you where we can, let's see. All right, so this is a website. Genworth is an insurance company that not only do they provide long-term care insurance, but they also do a lot of research and compile a lot of data. They do update this every year. So this is updated as of 2022. This is fascinating to me. What I bring up a lot when we start having this conversation with clients, when we start talking about long-term care in general and how we're going to approach this. If I've talked to you in the past, you've probably heard me say the cost of long-term care itself, depending on what that actually means, can vary widely in a small geographical region. So if we're looking in the Twin Cities, that's going to be much more expensive than just going up to St. Cloud, likely. And again, it depends on the level of long-term care we're looking at. This website for Genworth, I'm going to go ahead and drop this in the chat just as an interesting piece if you want to go look at this after the fact. But this, put this right here. Panelists, attendees. Okay, so I dropped the link in here if you want to go look at the data. I think it's very interesting. One thing I just want to draw your attention to. So this is, I typed in here Mankato, Minnesota. So this goes through some of the different assisted living, 31, 35. This is per month. So this is broken down into a monthly level. And so assisted living, nursing home. So you will see all these different costs broken down. Just to illustrate how this looks different, I want to compare Rochester to Mankato. So again, not that far from each other geographically, but we see Rochester, Minnesota, assisted living is $4,180 a month. That's a difference of $1,000, nearly $1,000 per month. And again, Rochester probably expected higher quality of care, just being in proximity to Mayo. But this here, I just want to illustrate how important it is as we dig into planning. If our plan is to eventually live in Arizona or live in Florida or move away from whatever state we're in, that's something to start thinking about. And again, just to reiterate the importance of the planning process in general. And those are the really, really essential things where if we're working with someone and they assume that everything's buttoned up and they move to a different region, well, that's time to review everything. And again, just reiterating the importance of financial planning in general and continuing to stay on top of these things. All right, I'm gonna go back. All right.
Where are we at? Question 4.
Yep.
Awesome. All right. So obviously, as Matt dives into, different costs and how they're calculated, it brings up a good point. Like, how do we pay for all this stuff? What are our options? Where can we look to provide funding for any level of care that we might find ourselves in? I did catch this as I was reading through my notes. I made a small typo on option C. It should say Medicare covers far more in terms of Medicaid. So actually there's 2 questions right in this answer, or two right answers in this question as well. So we'll take back one of our points. All right. Well, we're all tied up now. We'll just call it that. Medicare covers all any and all long-term care needs once a certain age, health status, asset level are reached. That is false. So good for you guys. That's just not the case. I'm going to dive into a little bit more of how roughly Medicare works and the different things that you can utilize it for. Payment for long-term care expenses by Medicaid is not subject to a state recovery at the Medicaid recipient's death. So we're going to dive into Medicaid a little bit more as we go, but at the end of the day, Medicaid is an offering through the government. It's actually kind of a joint venture between the federal and the state side of things, and the numbers and the definitions change slightly from state to state, but it's pretty heavily regulated and somewhat symmetrical across the board. But at the end of the day, if you go into Medicaid, there's certain limitations and rules and regulations that you must follow, and your scenario must be fit to this type of plan before you can even get into it. And one of the crazy things is at the back end of this, if you're in Medicaid and you're receiving benefit through the government, when you pass away, they can come back and claw back the costs that were incurred for that type of care. And so there is a lot of planning that needs to go in this area if you're anticipating it to be a primary source of funding for your care. All right. And really need to look closely at how we can protect things like your income and assets from, some of the nasty aspects of the Medicaid program that we're going to get into in a little bit, but very interesting. So only 14% of you thought that that was true. It is not the case. So just understand that if you do go through the Medicaid process or you're helping someone through it right now, there is a chance that there's some, repercussions, so to speak, on the back end of all that. Okay. Medicare does cover far less in terms of care than Medicaid. Okay. So that answer is in fact true. And Medicaid is the single largest provider of care, or payor as it's termed in the question, for long-term care costs across the United States. And as we dive into some of these, rules and regulations and what it actually takes to get on Medicaid, it's a very scary proposition when you think about what that means to us as a country, right? We have a very large segment of our population going through this, what it means to assets and resources and things of that nature, and just the general lack of preparedness and protection that a lot of people are facing in this area. So again, Medicare, all right, one might assume because it does specifically take care of, right, it's an insurance that essentially the government provides that takes care of elderly, seriously ill and disabled people, that would be the primary provider. It's just not the case. And in all honesty, it's very limited on what you can apply Medicare towards long-term care costs and needs. In fact, you can only tap into Medicare resources if you are going into a skilled nursing home. So this is like a kind of a older school definition of what long-term care is. You must be in a very specific type of facility before Medicare will tap in. The other aspect to that is they're only going to cover the first 20 days of your expenses in full. Okay. So whatever costs come up, Medicare will take the bill on those. But from days 21 through 100, that benefit gets reduced dramatically, right? You are going to have to take on a pretty high level of the costs that incur in that type of scenario. And then after day 100 of being in care, you're off Medicare. Okay. And there's some really unique rules where, let's say somebody goes into a nursing home and 60 days later they come out. All right. They haven't literally used their entire benefit. There's a window of time where if you go back into the home, it's just going to pick up where you left off. And if you think about that, you might be in a facility, or someone in a facility for a much longer period. Those bills are coming to you pretty quickly. Okay. So Medicare is, from my standpoint, not a very sound way to plan against long-term care costs, something that you need to understand and discuss with us if we're your advisor or whoever you're working with to understand those details. Funny how the government-run programs are confusing and hard to understand and very nuanced, right? It's just kind of the way it goes. So outside of that, if you're not in a skilled nursing home, they do cover certain costs as it relates to the home healthcare side of things. But again, very specific rules, very tough to get the benefit in full from that aspect, and kind of looks at the same type of scenarios where, it kind of falls off the longer you're receiving care and more that the expenses go up. Okay. And we're going to talk about why in a little bit here. Medicaid, on the other hand, okay. Again, as I mentioned, is a joint venture between state governments and the federal government. And essentially what is happening is the states are administering this or kind of creating the rules that are much more detailed than what the federal side is saying. And then essentially the federal government will provide some sort of resource or matching benefit, so to speak, to each individual state based on their needs and requirements. But you really are faced with some pretty specific rules and eligibility requirements. Okay. At the end of the day, you must be a United States citizen or a qualified immigrant, as they say. Funny how we're talking about education and people moving away from their parents. I moved like 2,000 miles away from my family, and I have a master's degree. So I guess that falls in line pretty quickly, but I am a qualified immigrant. So I guess I can tap into Medicaid if need be. You must be over 65, permanently disabled, blind. I did not know that if you were pregnant, you could tap into Medicaid. I don't know specifically why, but I was just very interested to learn about that. or if you're an underage child with specific needs or in care of an underage child. Outside of that, there are specific, what we call activities of daily living, requirements of your ability to take care of yourself, essentially. And it's things like eating, bathing, dressing, transferring, like getting in and out of bed, like Pam was dealing with in our previous question, moving around, and then essentially going to the bathroom and being able to, use your ability to think through things. So if there's 2 out of any of those 6 requirements, then you are kind of eligible for these types of benefits in that category. And that follows over into some of the other options we're going to talk about as it relates to insurance too, for the most part. But there are both asset and income requirements as well that will define whether or not you are eligible for Medicaid. Okay. On the asset side, basically all your investments. I mean, like wherever you have money stored away or some sort of value in an asset, it's going to be counted towards the equation that, filters into whether or not you can apply for Medicaid. And they don't really want to leave you with much, right? It's kind of scary when you think about the numbers. If you're single, you cannot have more than $3,000 of total assets. That's a small number, right? If you're married, they give you a little bit of a break and they bumped it up to 4,000. So essentially you must spend down your assets before you can tap into the Medicaid system. Or again, we'll talk a bit more about why. They do give you a little bit of help for things like, hey, if you own a home, they'll limit how much equity you can maintain inside of your home. It's right around 500,000 for most states. Some states, again, because it's all individually managed state by state, they bump that level up to 750,000. So depending on where you're coming in from today and joining us, you might have a little bit more of a reprieve in that area. But ultimately, they don't leave you with a whole lot of availability in assets to maintain things. And that leaves a bit of a concern, right? Especially for a spouse that's not in care, or a scenario where these assets are shared by 2 individuals. And there is a very specific process that Medicaid requires you to go through. And you need to be careful about it, because some assets are not countable towards this specific equation. But it's like stuff you find in your house, like jewelry, furniture. They give you a little bit of reprieve on the equity, a car, and then some nuances around like assets that provide you income. But they're also going to tap into your income, and you have specific limitations there. But at the end of the day, you have a little bit of reprieve on that side of things. And if you're married, the limitations kind of jump up for the I guess called the surviving spouse, the individual not under care. The limits are, again, depending on the state you're calling in from, go from about 27,000 to 137,000. So a wide range. Yeah, but it's not still a ton of money, again, depending on where you are in life and the time frames you're planning around and how the spouse is going to, provide income and things like that. There's a 5-year look back provision on all of this stuff too. So anyone that's like, well, I'll just be sneaky about this and change things around, you got to do it ahead of time. You got to create some unique planning around this if you're really concerned about preservation of assets, but also wanting to tap into some of these public sources of care. Okay. At the end of the day, if you break those rules on the 5-year look back, what's basically going to happen is there's an equation on like what you did to break the rule. Like, let's say you sold a specific asset for an amount and you collected a benefit and passed that on to someone else. They're going to look at that, run a bit of an equation, and kind of say that, like, based on those numbers, we're going to reduce the amount of time that you can tap into this benefit, or reduce the amount of benefit you get moving forward. So got to be careful, got to be very careful in this area. To me, and maybe you can jump in on this, Matt, a lot of this planning, like, not only needs to rope in an advisor that's dealing with the asset specifically in the accounts or whatever it is, and the overall management of the plan, but an estate planning attorney is going to like earn their weighting, in this type of equation, and providing the right details and, structures that exist that can ultimately protect you. On the income side, basically everything that you make from an income, if you're going into the Medicaid system, is going to be tapped into. I mean, there's a few nuanced details in there, but I wasn't really able to find anything specific on like what they give. Like, it's a kind of a case by case scenario, but basically what I was able to uncover in the details was whatever income you have is going. Yeah, you name it, basically everything. On the spouse's side, again, there's a bit of a reprieve, but depending on how you set these things up and in what state you're coming in, there's a minimum monthly maintenance needs allowance. MMMNA is a mouthful, as the system calls it. And that monthly allowance is not huge. It's between about $2,100 and $3,400 a month in kind of income we can remove from that scenario. Okay. When it comes to the state recovery side of things, right? The question we posed was, can Medicaid even go back and do this? Well, yes, they can. In general, the assets that we just talked about that were exempt, right? The non-countable items like your home, your car, your furniture, all of these things, they are no longer exempt from that clawback provision where if you go into Medicaid and you receive care, Medicaid can then come back and attach themselves to certain assets. Okay, we're going to talk a bit about how to protect in the grand scheme about these things. But again, got to be very careful if we're planning to tap into these resources, because it's an underfunded system. The demand is very high. The supply is very low. Expenses are going up. So all of these organizations, the insurance companies, Medicaid, Medicare, they're coming together to try to find solutions to this, but it's a growing problem, I would say. So just understand, like, if you're going to plan around that or you don't know what to do, like, come and talk to us, talk to someone that understands this area. But again, there are some ways that you can kind of limit what Medicaid could tap into. And there's certain scenarios for surviving spouses and what do we call that? Like disabled children and all of those scenarios like that, where we can remove some of those assets. So case by case, very hard to get into the nuances of it, unfortunately, but just something that I would very highly recommend you think about and plan around if you're going down that track.
You must have just taken some continuing education on long-term
care.
Oh
man, yeah. I want, as Matt just mentioned, it's an interesting topic, and he looked at me when we were preparing for this and said, I don't want to do any of the technical stuff. So he asked me to find out all this information and get the details. And long-term care is a pretty interesting subject, but at the end of the day, there's just so many ins and outs and little avenues you can go down. But
I do remember, so that clawback, just a funny story. If you look at the history of long-term care, that's the part that fascinates me. And I did find a website, and I don't know that I have the link, but it just goes through like this whole history of all the progress. And that clawback didn't exist at first. Mm-hmm. So that was put in, and it's just these steps along the way where it's like, oh, well, we've got about this. And I did hear a story when I took a long-term care course of a guy that said in the beginning, they didn't specify what kind of automobile or vehicle. So people would go buy an RV, and that would be considered the motorized vehicle. So over time, more and more of those, loopholes have been taken away. So.
Yeah, absolutely. That's funny.
All right, I jotted down a few notes. That was a ton of information. I hope you guys were able to keep up. I jotted down a few notes that I think are really interesting. I want to get through the rest of the quiz questions, and I think Scott will cover some of these in the next handful of questions as well. But if not, I have a few things I want to circle back on that I thought were interesting when you're going through that. All right, so question number 5. Again, just going on the trend of long-term care insurance and the history of this. This is a question that I was super excited to actually find what the real answer is to this, because so many times over the years I've said, well, let me read the question first. The estimated number of insurers offering pure long-term care insurance in the year 2004 versus the year 2020 is, and again, the first number was in 2004, the second number is in 2020. So 52% of you selected 104 in 2004 and 12 in 2020. 34% of you selected the flip of that, so actually more, 12 in 2004, 104 in 2020. 10% selected 128 and 125, and 3% selected 348 and 423. Nicely done, everybody. You did get this correct.
I think they're winning now.
So I think it's 3-2, actually. So the correct answer is the first option. So it's 104 and 12. And I've said this, going back to what I was saying before, over the years, I've said this so many times and talking to people that the number of long-term care insurance, the number of insurance companies that jumped into the long-term care industry or area, there was a lot more, and it's just steadily continued to fall off over time. So I didn't know what that number actually was. So I was actually really, really excited to dig into this. The best I could find for comparison was 2004. It was actually really challenging to dig this number up. So the best I could find was comparing 2004 to 2020. So it's thought that there was 104 insurance companies that offered pure long-term care insurance, and I'll explain that in a second, back in 2004, and then comparing that to 2020 of about 12. And again, that is somewhat of an estimate, but that's the best that I could dig up. In the 90s, first of all, this all kind of blew up in the 80s into the early 90s. That's when we saw a whole lot of people jump into it. I read a really interesting paper that was at HHS.gov, a case study of understanding why companies exited the long-term care insurance industry and no longer offer that insurance. And the majority of it was just profitability. So what we talk about often is a whole bunch of insurance companies saw this as an opportunity. Baby boomers, large generation, kind of changed everything, right? And there's this, it's like this, this big ball moving through the snake, as it's been referred to as. And so they saw this as, hey, this is going to be in demand. We already see this trend going up, as we talked about earlier. And so we can make money. And I would hope there's some goodwill there and they want to help people, but, and they realized real quick, they did not know how to charge premiums for this. So for those of you that have policies that existed before, you may have had conversations with us or someone else making the decision about whether to continue to pay increasing premiums or to drop it altogether. I just wanted to put this question in here just to show how challenging of an area it is to predict and kind of segue into what the different options are and where we've seen the industry go lately. So for the sake of time, I'm going to leave it at that. We're going to go ahead and move on to question 6.
All right. So which of the following statements is false? There is a tax credit for paying your long-term care costs out of your IRA. 24% of you said that was incorrect. Life insurance death benefits can be accessed prior to death and are tax-free. 14% of you said that was the incorrect answer. Annuities provide immediate tax-free leverage of 2 to 3 times your initial deposit if used for long-term care costs. 28% of you thought that was incorrect. Long-term care insurance is subject to annual premium increases. I think we just got another point, Matt. Because Matt just let you know that is, in fact, something the industry is facing. Okay. So no, you do not get a tax credit for paying long-term care costs out of your IRA. That is the answer to question 6. That is false. Okay. You can access life insurance death benefits prior to dying. A lot of people don't know that. There's unique ways. I'm going to get into this really quickly. Again, for the sake of time, if you want to know more about this stuff, reach out to me. All right. And I will happily dive into this stuff because I guess I'm nerdy about insurance and I kind of enjoy some of the nuances to it. Annuities do provide, the right types of annuities do provide some very substantial leverage. Okay. And if used for long-term care costs, some nice tax incentives as well along the way. Now, not every annuity. Okay. So maybe that was a bit of a tough question to navigate in reality, but what I wanted to point out was that there are a number of different solutions, products, tools, whatever you want to call them, that exist in our universe to cover against the cost for long-term care. The most basic, way of looking at this is, again, the Medicaid and Medicare systems that are in place are limited, right? One has very, limited access to it. There's not a lot of funding. It drops off right away. The other one is the highest used type of care in this country, but you basically have got to be impoverished to get to that, right? And so it's difficult to tap into these resources. So the next logical reason or way to plan against this, I should say, is getting into the private side of things and taking control of your own destiny, buying yourself some sort of, insurance product, let's say, or planning around what you anticipate your costs to be and allocating your own resources to cover it. I mean, we can start with simple: use cash, use your investments, save money, plan for it. Brings up some different concerns and risks, as many of you that are working with us understand that there's liquidity needs and things that come up in the conversations that we're having, that doing this is going to maybe limit your options, right? It's going to take away from your availability to spend dollars in other areas, knowing that those dollars are positioned for a pretty significant cost down the road. Matt did some rough averages, but just think of this. I think these are Minnesota numbers, but average stay in a nursing home, 2.5 years. Average cost, a little over 100,000. Do the math, right? Those costs do not include anything that would come up prior to going to a nursing home. Custodial care, skilled care. I mean, you might have a whole bevy of expenses that creep into the scenario prior to that. So outside of funding it yourself, there are ways to create leverage through things like insurance products, okay? Life insurance, you can tap into things like cash value. You have what's called accelerated death benefit provisions. Most policies come with these included, and they're not generally an additional cost. But if you have like a chronic illness, which is a specific definition in insurance, or a terminal illness, which is another specific definition in insurance, you could tap into these death benefits before you die and be able to pay for some of these specific costs. All right. It's a very different way of looking at it. But at the end of the day, it removes some of the concerns that traditional long-term care presents: increasing premiums, difficult underwriting, stuff like that. There are things called insurance settlements. Like, there are companies that will buy your insurance policy, give you money, and then you can go and fund it. Very, limited these days. You don't hear a lot about them too much. And again, something that probably should plan around and avoid if possible, but it's kind of a last ditch effort, so to speak. Life insurance is very unique. It's evolved over time. The need for long-term care has presented insurance companies opportunities, as Matt was just talking about. And so although a lot of companies are no longer providing traditional long-term care, a lot of companies are providing what we call hybrid benefits, where you can buy life insurance that has a long-term care provision added into it for an additional cost, but now it gives you the best of both worlds. If you don't use it, life insurance taps in when you die at the end of your life, money gets passed away or passed on, I should say, to your beneficiaries. If you do need it, you can tap into a specifically defined benefit for long-term care and still have a death benefit for your heirs and beneficiaries. So it's a way to kind of use dollars to do a couple different things. Remove some of the surprises with long-term care, premiums and stuff like that, and opens up some very flexible use for the dollars. Annuities, again, if you get the right one, right in the contract that you get into and right into the definitions of what you're purchasing, it'll tell you your income benefit on this annuity will be doubled or tripled if you go into long-term care. Or your initial benefit, your premium that you've deposited into that annuity will be doubled or tripled instantly should you go into long-term care. So again, it's just a matter of choosing the right solution and picking the right product, so to speak, that will fit into your specific scenario. Long-term care insurance, somewhat confusing. There's a lot of things to concern ourselves with. How the benefits get turned on, we talked a little bit about that, okay? The type of policy you buy, does it cover everything, or is it like just nursing home, just custodial care, just home care? You can define that in the type of insurance you buy these days and be very specific or very broad based in the way that you plan, okay? The benefits have limits on them, right? How much you can access in a day, a month, a year, and depending on how you set that up, the benefit's either going to be a reimbursement or an indemnity benefit. So you're either going to get the exact dollar amount you spent on the care back in a reimbursement, or if you go into care and your costs are lower than what the benefit is on your policy, they're just going to give you the full amount. So you could make money. I don't know if we want to call it that specifically, but let's say your costs are $100 today and your benefit's $150 a day. You receive the full benefit and you have $50 extra to do with what you want, I suppose. There's things like elimination periods. Long-term care is health insurance. We got to remember that at its core. So there's like what we would call our deductible, so to speak. You got to cover care for a certain period of time. But you can tie on things like inflation protection and see your benefits grow to keep up with the demands and the cost rising over time. And then we can play around with tax benefits as well. You can really dive into the nuances of how plans are set up to create tax-free benefits, or if the scenario presents itself, to utilize a non-tax qualified plan to help you out in specific ways. Again, very nuanced, but long-term care has got a lot of moving parts and bells and whistles, as Matt had mentioned. So talk to us. Let us know if you have specific questions. We're here to help.
Awesome. Move on to question number 7. This is pretty cut and dry. I'm gonna get through this one quickly. According to the ACL, which is the Administration for Community Living, a 65-year-old in the year 2020 had what chance of needing some type of long-term care? 21% selected 48% of people, 38% of you selected 33.3, 38% of you selected 69%, and 3 selected 78%. I guess we have to give this one to you. So correct answer is 69% of people. So a 65-year-old in the year 2020, there's a 69% chance of requiring some sort of long-term care. Again, going back to earlier, that can mean a wide variety of different things. One quick interesting fact is, on average, women need care longer than men. 3.7 years for women versus 2.2 years for men. 1/3 of today's 65-year-olds may never need long-term care support, but 20% will need it for 5 years or longer. So what is it, 4-3 now? I think us in favor of
Close
us?
game here.
All right,
Let's
let's see if we end in a tie. Let's go on to question number 8.
All right, for
and
the
we'll
sake
wrap
of
it up.
time, I'm just going to jump right to the right answer here. Okay, so I'll read off the question. An insured who participates in a state partnership program may be eligible for an exemption to Medicaid's asset sped down rule, equal to what amount? All right, the right answer here is C. The total lifetime benefits payable through the long-term care partnership policy. So if you purchase a policy that is qualified for partnership, okay, through the Medicare, Medicaid programs that the states have set up for us, you can actually protect your assets from all of that scary Medicaid stuff I went through a few minutes ago. Back in the early 80s, well, mid 80s, I should say, a very specific foundation, what's the name of it? Robert Wood Johnson Foundation, set out on a mission to kind of help with this growing demand. As Matt said, this started blowing up in the early 80s. And so they stepped in and tried to work with state organizations, Medicare and Medicaid, to provide some solutions and abilities for people to fund this stuff. They started with 4 states initially, okay, and they had some really wild rules, as we talked about. Like, if you bought a policy, like all of your assets were covered. Like, how crazy is that when we think about the specific rules today, that if you just bought a policy, all of your money could be protected? Well, the rules changed regularly, okay? And back in 1993, there was some specific tax regulation changes that took place that froze everything and decided that it needed to be revamped, okay? And from there, all of the different states were included. And again, in 2005, there was another change, okay, that the tax code stepped in and kind of made some major updates and brought us to where we are today, where we're dealing with, you know, specific spend down rules and regulations to receive these partnership qualified programs and all of that. But at the end of the day, the biggest thing that's come out of this is that if you plan for it, we can actually protect your assets from this spend down provision, tap into resources that exist for us today. And it's the rules to the game. If we play it properly, you can plan for your costs, cover everything that you want, and leave your loved ones in the scenario that you want them to be if you find yourself in care. So again, the reality is this is only a partial solution. We have not solved the problem as an industry as a whole. It's still growing. And there's some very stringent requirements and rules as far as tapping into partnership benefits, where like the long-term care policies and stuff like that need to be very detailed and hit on some very specific requirements before you can get in there. So let us know. We can help you design those types of things and go through the rules and let you know if your current policies that we had nothing to do with before you met us, we can let you know where you stand and get into the details. So long-term care, I think that's it.
Thank you so much for
All right.
joining us. We did have someone mention you lost a connection. I apologize if you all had that experience. We may have had some spotty internet here, but appreciate you hanging in there with us. Thank you so much. Virtual handshake for Ty, 4-4, everyone. We'll see